Let me tell you about Marcus. Marcus is 34 years old, earns about $90,000 a year, and has been saving for 5 years to buy a house. He finally did it. He bought a beautiful 3-bedroom home in the suburbs for $420,000. He posted about it on Instagram. His mom cried. His co-workers congratulated him. His uncle shook his hand and said, "Son, you're finally building real wealth." And Marcus felt proud. He felt like he had finally crossed the finish line of adulthood. Then, 6 months later, the HVAC system broke down. That was $8,500. Then the roof started leaking. Another $6,000. Then property taxes went up. Then his commute got longer because he had to move farther out to afford the house. Then he did the math, the actual math, and he felt something cold settle in his stomach. He had been told his whole life that renting is throwing money away. That buying a home is the smartest financial move you can make. That homeownership is the foundation of the American dream. But nobody told him the full story. Nobody sat him down and said, "Hey, let's actually run the numbers before you sign that mortgage." And that's exactly what we're doing today. Because the idea that renting is throwing money away might be one of the most expensive financial myths in American culture. And I'm not saying this to be controversial. I'm saying this because the math, the real unfiltered math, tells a completely different story than what your parents, your real estate agent, and society have been feeding you. So let's break it down. First, I need you to understand something called opportunity cost. This is the concept that every financial decision you make has an invisible price tag, not just the money you spend, but the money you could have made if you had used those funds differently. Most people never think about this. They see the mortgage payment and compare it to rent and say, "See, it's almost the same." But that comparison is wildly incomplete, and here's why. When you buy a home in 2026, you're not just paying a mortgage. You're tying up a massive amount of capital up front. Let's say you buy that same house Marcus bought, $420,000. To avoid PMI, private mortgage insurance, you need a 20% down payment. That's $84,000. Gone from your investment account on day one. Plus closing costs, which typically run between 2 and 5% of the purchase price. On a $420,000 home, that's another $8,000 to $21,000. So before you've slept one night in that house, you've spent somewhere between $92,000 and $105,000 just to get in the door. Now here's where it gets interesting. What if instead of putting $84,000 into a down payment, you had invested it in a simple S&P 500 index fund? The S&P 500 has historically returned an average of about 10% annually before inflation. Let's be conservative and say 7% after inflation. That $84,000, compounding at 7% for 10 years, grows to $165,000. You didn't buy a single stock. You didn't pick any winners. You just let the market work for you. And now you have 65% more than you started with, completely passively. But when your money is locked in a down payment on a house, it's not earning anything. It's just sitting there, tied to the value of your property. That's opportunity cost. And almost nobody talks about it. Now let's talk about what a mortgage actually costs you, because I promise you it's not what you think. Take that $420,000 home. With a 20% down payment, you're financing $336,000. At today's mortgage rates, which as of early 2026 are still hovering around 6.5% to 7% according to Freddie Mac data, your monthly payment on a 30-year fixed mortgage is roughly $2,100 to $2,200 per month, just in principal and interest. But that's not your full housing cost. Add property taxes, which in most U.S. metro areas run between 1% and 2% of the home's value annually. On a $420,000 home, that's $4,200 to $8,400 per year. That's $350 to $700 more per month. Then add homeowners insurance, typically around $150 to $200 per month. Add HOA fees if applicable, anywhere from $0 to $500 or more per month, depending on the community. And then add maintenance. Here's the rule that financial planners use. Budget 1% to 2% of your home's value every single year for maintenance and repairs. On a $420,000 home, that's $4,200 to $8,400 per year. And before you say, "I'll just fix things myself," ask Marcus how that worked out when his HVAC gave out in August. So your total true monthly cost of homeownership on this $420,000 property is somewhere between $2,700 and $3,500 per month, when you stack everything up honestly. Now, what does rent cost for a comparable three-bedroom home in most U.S. suburban markets? According to Zillow's 2025 rental market data, the national median rent for a three-bedroom home is approximately $1,900 to $2,200 per month, depending on the metro area. You are paying more every single month to own. And that's before we even talk about the opportunity cost of the down payment. But wait, you're building equity, right? That's the whole point. Let me explain what equity actually means and how slowly it builds. In the first years of a 30-year mortgage, almost all of your payment goes to interest, not principal. This is called amortization, and it is specifically designed to benefit the lender. In year one of that $336,000 mortgage at 6.75%, you're paying about $1,800 per month in interest and only around $300 per month toward the actual loan balance. You're essentially renting money from the bank, and the bank is getting rich off you first. By month 12, you've paid about $21,000 in mortgage payments. Of that, roughly $18,000 went to interest. You've only paid down about $3,000 of your loan. You still owe $333,000. Does that sound like building wealth to you? It gets better only very slowly. It takes about 8 to 10 years before the scale tips, and you start paying more principal than interest each month. Now let's talk about the home appreciation myth, because this is the big one. People say houses always go up in value. And historically, yes, home prices have risen. But here's what they don't tell you. According to Nobel Prize-winning economist Robert Shiller, who literally wrote the book on housing bubbles, U.S. home prices from 1915 to 2015 increased by an inflation-adjusted return of just about 0.6% per year, less than 1% in real terms. Your house is not the investment vehicle your uncle thinks it is. Yes, home prices have surged dramatically since 2020 due to pandemic-era demand, supply shortages, and historically low interest rates. But that was an anomaly, not the norm. And in 2023 and into 2024, we already saw many markets cool significantly. Cities like Austin, Phoenix, and Boise saw home prices drop 15 to 20% from their peak highs. People who bought at the top in 2021 with a 3% mortgage suddenly found themselves with a home worth less than what they paid, while being locked into a significant debt. That's a risk renters simply do not carry. Let me introduce you to someone else. Her name is Priya. Priya is 31, earns $80,000 a year, and made a different choice. When everyone around her was scrambling to buy before rates went higher, Priya stayed in her $1,200 a month apartment and invested the difference. She took what would have been her down payment, $75,000, and put it in a diversified index fund. Then every month, she calculated the gap between what she'd pay to own a comparable home in her city and what she was paying in rent. That gap was about $900 per month. She invested that too. 5 years later, her initial investment has grown to approximately $105,000. And her monthly contributions of $900, invested over 60 months at a 7% average annual return, have grown to over $63,000. Combined, she now has a liquid, accessible investment portfolio worth over $160,000. Marcus, who bought the house. After 5 years of ownership, he's built maybe $40,000 in equity from his principal payments, assuming his home hasn't declined in value. He's also spent an estimated $20,000 to $25,000 in maintenance and repairs. His net position is better than when he started, yes, but not by nearly as much as people assume. And his money is completely illiquid. He can't access it without selling the house or taking out a loan. Priya can access her money in 3 business days. No permission slip from a bank required. Now I know what you're thinking. But inflation will make the mortgage payment cheaper over time while rent keeps going up. And you're not entirely wrong. That's one of the few genuine advantages of a fixed-rate mortgage. Your principal and interest payment is locked. It does not increase with inflation. And as wages and rents rise over 30 years, that fixed payment becomes a smaller and smaller portion of your income. That's real. I'll give you that. But here's the counter. Renters are not helpless against rent increases. Renters have flexibility. If your rent goes up dramatically, you can move. You can negotiate. You can relocate to a cheaper market. You are not stuck. A homeowner who needs to move faces realtor commissions of 5 to 6% of the sale price, plus closing costs again, plus moving expenses. On a $400,000 home, Just the realtor fees alone cost you $20,000 to $24,000 every single time you sell. According to the National Association of Realtors, the median homeownership tenure in America is about 8 years. If you're moving every 8 years, you're paying those transaction costs again and again and again. And those costs destroy the wealth-building narrative completely. Let's run that transaction cost math. You buy a home for $420,000. You pay closing costs to get in, call it $10,000. 8 years later, you sell? Your home has appreciated at the historical average, so let's be generous and say it's worth $480,000. But you pay 6% in realtor commissions. That's $28,800. Then there are closing costs on the sales side, title insurance, attorney fees, potentially another couple of $1,000s. You walk away with maybe $100,000 in equity before you factor in all the maintenance you paid, all the property taxes you paid, and the opportunity cost of your down payment sitting idle. Compare that to previous situation. No transaction costs, no commission, no waiting 60 days to close. Just freedom. Now here's something that almost nobody talks about: the psychological and emotional cost of homeownership. And I'm going to be real with you here, because this matters more than most people admit. When you own a home, you are responsible for everything. The leaking pipe at 2 in the morning. The foundation crack that sends you into a spiral of panic. The neighbor who lets his yard turn into a jungle. The neighborhood that starts changing in ways you didn't predict. Homeowners carry a mental load that renters simply don't. And that stress has a cost. Maybe not a dollar figure, but a quality of life cost that is very real. Renters, in contrast, maintain something incredibly undervalued in personal finance: optionality. You can chase a better job in a new city without the anchoring weight of a property to sell. You can downsize quickly if life changes. You can scale up without a 20-year commitment. In a world where careers, industries, and entire cities are shifting faster than ever, being financially and geographically nimble is not a weakness. It is an asset. According to a 2024 study from the National Bureau of Economic Research, homeowners are significantly less geographically mobile than renters, and this reduced mobility has been shown to limit career advancement and lifetime earnings, especially for younger workers in fast-changing industries like tech, healthcare, and finance. The mortgage that was supposed to build your wealth might actually be capping your earning potential by trapping you in a location. Let that land for a second. Now I want to be absolutely clear about something, because nuance matters here. I am not saying never buy a home. I am not saying homeownership is always wrong. What I am saying is that the decision needs to be made with clear eyes and honest numbers, not with emotional mythology that has been handed down for generations without being questioned. There are situations where buying makes excellent financial sense. If you're planning to stay in one place for 10 or more years, the math starts to shift in the buyer's favor. If you're in a market where rent is genuinely as high or higher than ownership costs, buying might be the better call. If you have a very large down payment, reducing your mortgage balance significantly, and if rates drop and you can refinance, the numbers can work well. And if owning gives you stability, community, and the freedom to renovate and build the life you want in a specific place, those are legitimate reasons that have real value. But those are your reasons, not the reasons your uncle, your real estate agent, or the broader culture gave you. Those reasons deserve scrutiny. Here's a practical framework. Before you decide to buy, ask yourself honestly, how long am I planning to stay in this city? If the answer is less than 7 years, renting is almost certainly the better financial choice. Then ask, what is the price-to-rent ratio in my market? This is calculated by taking the home price and dividing it by the annual rent of a comparable property. According to traditional financial theory, a ratio below 15 suggests buying is more attractive. A ratio between 15 and 20 is a gray zone. A ratio above 20 suggests renting is more financially efficient. In many major U.S. cities right now, including New York, San Francisco, Los Angeles, Austin, and Seattle, price-to-rent ratios are sitting between 25 and 40. That's telling you something very loudly. Then ask, what would I do with my down payment money if I didn't use it for a house? If the honest answer is that it would sit in a savings account earning nothing, then the opportunity cost argument weakens. But if you would invest it intelligently, the math becomes dramatically different. And finally, ask, am I buying this home because it makes financial sense, or am I buying it because I feel like I'm supposed to? Because that question might be the most important one of all. There's a concept in behavioral finance called the endowment effect. It refers to our tendency to overvalue things we own simply because we own them. We feel more attached to a house than an investment account, even if the investment account is worth more, growing faster, and more liquid. Why? Because the house feels real. It feels like home. And that emotional attachment causes us to make financial decisions that don't add up when you look at them rationally. Your parents' generation operated in a world with very different economic conditions. Mortgage rates in the 1990s were higher, yes, but home prices relative to income were dramatically lower. The median home price in 1990 was about $123,000 when the median household income was about $30,000. That's a ratio of roughly 4 to 1. Today, the median home price in America is around $420,000 according to the U.S. Census Bureau, while the median household income sits at around $77,000. That's a ratio of 5.5 to 1. Affordability has gotten significantly worse. The math that worked for your parents does not automatically work for you. So here is your action plan. Starting today, first, run your own numbers using the New York Times Rent versus Buy calculator. It's free, it's rigorous, and it accounts for opportunity cost, maintenance, transaction costs, and appreciation. Plug in your actual market, not some national average. Your actual city, your actual neighborhood. Let the math speak. Second, if you're not yet investing the difference between what you'd pay to own and what you pay to rent, start immediately. Open a brokerage account if you haven't. Put that money to work in a low-cost index fund. Let compound interest do what mortgages can't. Grow your wealth without tying it up. Third, stop listening to the noise. The Instagram post of someone's new home doesn't show you their maintenance costs, their property tax bill, or their lost opportunity cost. Social media shows you the celebration. It never shows you the spreadsheet. And fourth, give yourself permission to be strategic instead of sentimental. Buying a home is not a moral achievement. It is a financial decision. Treat it like one. Marcus, by the way, is still in his house. He doesn't regret it entirely because he loves the space and the stability for his family. But when I asked him what he wished he'd known before buying, he said, "I wish someone had shown me the real numbers. I wish someone had told me it wasn't as simple as rent being throwing money away." He said he would have still bought eventually, but maybe not in 2021 at the peak, maybe not in that market, and definitely not without understanding what he was actually signing up for. You, on the other hand, now have the numbers. You have the framework. You have the clarity that most people spend years trying to reverse engineer after the fact. The homeownership myth is one of the most persistent and expensive beliefs in American personal finance. And the people who benefit most from keeping it alive are the real estate agents earning 6% commissions, the mortgage lenders collecting 30 years of interest, and the home builders who need buyers. That doesn't mean homeownership is evil. It means you need to be the one doing the math, not the people profiting from your decision. Rent strategically, invest aggressively, and when the numbers genuinely point toward buying, go ahead and buy. But do it with your eyes open, your calculator running, and the myth officially busted. Because building real wealth is not about what you own. It's about how intelligently you deploy every dollar you earn. That's the game. Now go play it smarter.